Hey Bowtie Nation, Joseph Hogue here and updating our dividend stocks portfolio. The market has been crazy this year with the Fed expected to raise rates through 2024. It might get worse before it gets better. That means I wanted to put together a list of dividend stocks that not only puts cash in your pocket, but is going to protect your money. In this video, I'll show you a dividend screener to start your list. Then we'll check it against the best stocks by return during the last stock market crash and reveal 7 dividend stocks to buy for that safety and cash flow. You know we can't get started though without that special shout out to all you out there in the nation. Thank you for spending your part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. We'll be using some research from Stock Card that we used in a recent video, checking our dividend stocks for how well they held up during the worst of the 2008 crash, the ones that protected your money. I'll leave a link to Stock Card in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the Stock Picks section. It's free to follow and you'll get email notifications whenever I buy or sell from the list. As a special bonus, I've negotiated an exclusive discount for all you out there in the community. Use the promo code BowtieNation for an exclusive discount beyond the free trial. I want to get into our dividend list, but I'll show you that screener that I used and what I'm looking for in these dividend stocks next. I recommended Gilead Sciences, ticker GILD, last year with the share price rising 13% on top of that 5% dividend yield. Their shares are back down on problems around its strategy for diversifying its pipeline of drugs around that focus on HIV and hepatitis into some cancer treatments, but this is still one of the best stocks and drug makers. Gilead has a commanding lead in HIV drugs, where it serves 80% of the patients in the United States, really locking in that cash flow. This is just one of those companies that is always discovering new drugs, and revenue has started to recover. It's up 23% from the 2018 low to $27 billion last year. Now that's still down from the $30 billion in 2016, so the shares have been pretty rocky, jumping as high as $84 each in 2020 to as low as $57 per share recently. Now that uncertainty though has made for a good value play, with the stock trading at just 2.9 times on the price to sales basis, more than 20% below its 5-year average. Looking back on our research, and you see Gilead was one of only 8 stocks to post positive returns in that October 2007 to the March 2009 crash, producing a 6% return on top of the dividend, all while the overall market lost 55%. Analysts have an average price target of $70.41 a share, more than 15% upside from the current price. This next dividend stock has one of the strongest cash flow stories right now. Newmont Corporation, ticker NEM, the world's largest gold miner. And through acquisitions and exploration, Newmont has built enough reserves to produce nearly 8 million ounces of gold every year through 2030 and beyond. Management is forecasting up to 7 million ounces of production a year through 2025, all while reducing expenses to an all-in sustaining cost of just $850 an ounce. The price of gold surged to $2,000 an ounce on the Ukraine invasion, and while it has come down a little since, should stay firmly above $1,800 an ounce on stock market uncertainty. And this chart really says it all for the company. At just $1,200 an ounce, the company is able to sustain its dividend, pay down its debt, and invest in the future. With the price of gold forecasted to rise, anything above that $1,200 benchmark is going to be cash flow and dividend growth. Newmont is generating over $3.4 billion in free cash flow a year, an increase of 61% annually over the last 3 years. While shares of Newmont fell 14% during the 2008 crash, I think there's better stability now, and higher gold prices should support it. Even that 14% drop, though, provided a 40% protection to your money. And the average analyst target is for about an 11% upside to $80 a share over the next year. We've still got 5 more dividend stocks to highlight for that safety and cash flow, but I wanted to get you started on how I found these and what to look for yourself. I started with the stock screener on Stock Card, and one feature you'll also want to check out is this ETF screener, but we're going to stick with stocks for right now. And I just want to narrow our list down with a few of the criteria here. I want larger companies, so we're going to stick with those larger than that $2 billion in market cap, and I probably could have just toggled the larger caps here, only those with that real financial size to perform no matter what the economy does. I also want companies with good cash availability, so a strong balance sheet cash position and limited debt to make sure that dividend is safe. And finally here, I'll narrow the list to just those with a good history of dividend payments and only those with a dividend yield above 3%. Anything lower than that, and it's not really a dividend stock in my book. And that still leaves us with almost 300 dividend stocks that meet the criteria, but using that past research on stock returns during the crash, it's going to help us narrow this down even further to only those with the potential to protect your money. And now you can play around with that screener, maybe narrow the list a little further with some of the other criteria, but I wanted to rely more on those past returns research for our top 7. Shares of Altria Group, ticker MO, pay one of the highest dividends on the list at 6.5% yield and could be your best bet on safety. While cigarette volumes are on the downward trend, pricing has kept up, so the company's cash flows are extremely stable. Plus, it's got this moonshot investments in vaping and cannabis that are going to help grow the business into the future. For example, the company has a $1.8 billion stake in cannabis company Kronos Group that gives it a 45% share of the company, basically setting it up for a future acquisition. It also owns 10% of the Anheuser-Busch company, which gives it that steady growth in the alcoholic beverage market. And just this April, when the market plunged 10% in 1 month, shares of Altria jumped 6.4%, protecting your money and producing that cash flow. They dropped about 17% through the worst of the prior crash, but only about 10% if you factor in the dividend. The average analyst target of almost $57 a share is only about 2% higher from here, but this one is that cash machine, and it just keeps on paying. One of the most dependable dividend stocks on the list, Amgen Inc., ticker AMGN, pays a 3.36% dividend and has returned another 7% annually on the price. Amgen reported stellar first quarter results, really driving home the value here. The company produced $2 billion in free cash flow in that 3 months alone, raised its dividend by 10%, and bought back $6.3 billion in shares. Now, just as important though, management reaffirmed its 2022 guidance for $17 to $18 a share in earnings. Now that is so important right now because what we're seeing, most of these companies lower their expectations for this year's growth, and it is destroying the stocks. Amgen had some very strong drug launches in the first quarter that are just picking up momentum, and this is one of the best pipelines in drug makers. The company has more than 39 candidates in clinical trials for over 50 indications and is constantly that new launch just keeping sales growing. And drug makers were some of the most reliable during the last stock market crash, with several names here, including Gilead Sciences, Abbott Labs, and Amgen all holding up. This 18% loss on the shares was still 37% better than the market, and the stock price has jumped 414% since 2009. Now, analysts only see this one up about 6% higher to that average target price of $246 a share over the next year, but it's a dependable dividend stock that will always produce. Shares of utility companies are the traditional safety plays, and the next on our list, the Southern Company, ticker SO, pays a 3.6% dividend. The company operates as a regulated electric utility, serving more than 4 million customers in Georgia, Alabama, and Mississippi, along with another 4.4 million customers in natural gas. And Southern has been one of the most aggressive in the utilities industry for its push into clean energy. In 2000, nearly 80% of the company's electricity generation came from coal. Today, it's just over 20%, and the company is pushing further into that nuclear, natural gas, and renewables than anyone else. The shares fell just over 20% in the prior crash, with a lot of those utility companies getting hit, but these are still relatively safe stocks from a bigger sell-off. The shares have come up quite a bit recently, so the average analyst target of $74 each only leaves about 0.5% upside, but these will protect your money. We're down to our last 2 dividend stocks, but I want to get your opinion on this as well. What dividend stocks are you holding for that safety during a crash? And scroll down and let me know in the comments below, which dividend stocks do you think are going to hold up? This next dividend stock actually surprised me. Toy maker Hasbro Inc., ticker HAS, and its 3% dividend yield. You wouldn't expect a toy maker, a stock in that volatile consumer discretionary sector, to do well during a stock market crash, but shares fell just 23% in the last crash, less than half the drop in the rest of the market. Now again, that might not seem like any great protection, but hey, I'll take a 23% loss instead of 55% any day of the week and twice on Sunday. And Hasbro actually has some near-term catalysts that could support the shares regardless of what happens in the market. Several activist investors, including Ancora, are pushing for changes at the company to unlock that shareholder value. And these could include spinning off popular divisions and selling its film studio, Entertainment One. Either would grab a strong valuation and a cash windfall for investors. Analysts have an average target of $105 a share, more than 15% higher from here, maybe on that push from activist investors, but just a strong upside potential. Another utility stock on the list, Consolidated Edison, ticker ED, provides service to over 10 million customers, mostly in New York and New Jersey, but also has a solid solar business nationally and pays a 3.4% dividend. Now, there are some catalysts for growth here as well, but what really attracted me to the shares here was that 46 consecutive years of dividend increases by Con Ed and a yield that's higher than most utility companies. 56% of the company's electricity generation comes from renewables, and it's the second largest solar generator in North America. Now, like we saw, while those utility stocks still got hit during the market crash, that 25% drop in shares here is less than half the loss on the broader market, protecting your money from another 30% in losses. This one also has a fairly strong upside to that average analyst target of $93 a share, almost 9% return on top of the dividend. Check out the 2022 portfolio on Stock Card, or click on the video to the right to see the 11 highest paying dividend stocks in every sector, the best dividend stocks in the market. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.